Welcome to Buy, Hold, Sell. My name's Matthew Kidman, and today we're going to discuss the 2016 financial year. On paper, it looked like it was very difficult to make money. There was no gains by the overall index. However, if you look a bit more closely, some stocks did very, very well. In fact, the top 5 stocks delivered an average return of 28%, and other stocks did not so well, which made the index look flat for the year. With me to talk about 2016 is Ben Rundle from NAOS and Ben Clark from TMS Capital. Ben, B2, we'll start with you.
Yep.
2016, unusual year. Was it an easy year to make money?
No, I think you had to scrap your way through the year to make money, and you had, I think, to have high conviction in those things that you wanted to buy. So certainly, small caps were a big part of the index's overall performance versus large chips shares. So, it wasn't an easy year.
So let's stick with the top 20.
Yep.
You're in your banks, you're in BHP, you're in Rio, you've lost money. How did we avoid that? What did you need to look for going into 2016? What were those drivers that took those other stocks higher?
Yeah, I think earnings growth is what you had to look for. And going into the start of the year, you did look at the banks and probably think, where's the earnings growth going to come from? We saw capital raisings occur right at the start of the financial year, which was always going to weigh down on things like return on equity and those sort of measures. And then there was a lot of volatility happening during the year in commodity pricing. It's probably one thing that we failed to do during the year was to start looking at the resource stocks when we saw total capitulation back in January, because that was pretty good buying opportunity, and probably reflective of the years. You probably had to be a bit more active during the year, particularly in those blue chip shares.
Okay, Ben Rundle, B1. Low interest rates.
Yep.
Historically low interest rates. Infrastructure, property trust shot the lights out.
Yep.
Was that a warning sign? Should we all have been positioned there, given what we knew?
Yeah, look, to be honest, at the start of the year, I would have thought that the run in a lot of the bond proxy stocks, like your REITs and your infrastructure stocks, was probably nearing the end. Now it kept going, and that's probably a lesson for everyone that, when you do hit a boom or boom times, it can go for a lot longer than what you think.
Trend is your friend.
The trend can be your friend, and it can overshoot on the upside. Those stocks have obviously done well. If you look at them now, they're just absolutely priced for perfection. And I think, I genuinely believe that we're in a once in a generation boom period in terms of bond prices. And when they go the other way, you just don't want to be in those stocks. And I think you'll see those ones that have performed really well this year will be in the bottom percentile. Maybe not next year, but possibly the year after.
What did you learn from 2016? What was the big lesson?
Probably a big lesson for us. In 2016, we really saw a reversal in the commodities trade. So it's been, an absolute. It's been a very difficult trade for the last few years. Following the bust from the China boom. Now, what we probably learnt from that was things in the underlying industry don't need to actually get that much better, but the stocks can. If the whole market's underweight and the whole market hates a sector, then there's only needs to be a little bit of improvement, and the stocks can really rally quite hard in your face. And if you're underweight or even short those stocks, they can do a lot of damage in a very short space of time. And you speak to the industry experts and that sort of thing, and they don't tell you that things have significantly improved.
Okay, we've got a bit of resource remorse. Ben, we're into 2017 now.
Yeah.
We've talked about the themes from last year. How does it look going into this year, and where do you want to be positioned?
That's a good question, because a lot, you look at a lot of the high quality earnings growth stories, and many are actually hitting all-time highs at the moment, in particular today. I agree that you wonder how much the yield compression can continue to occur in those sort of market darling safe stocks they've almost become now. I reckon, Matthew, where the sweet spot is reasonable yield, reasonable earnings growth at a reasonable sort of price. So like finding those stories, and also, if there's 20 to 30 stocks that you like on a high quality basis, there's normally 2 or 3 that are pulling back for some reason, which is unrelated to their price, and you've got to be very quick to take advantage of those situations.
Okay, Ben, what about the banks? Big part of our overall market.
Yep.
Reasonable yield, not a lot of growth, but we all know that they had to raise capital.
Yep.
That's baked in. Is that a place maybe where you want to be, given it's such a big part of our index?
Yeah, I don't think it is just yet. I think the operational headwinds are very much still there for the banks. They're pulling back on some of the lending parts of their books. And then you've got the overhang of, okay, what happens if Australia loses its AAA rating? Then all of a sudden, credit conditions can tighten up a little bit, which could make it harder. I still think it's too early.
Resources, can they keep going?
The prices of resource stocks probably can. I wouldn't. Well, I mean, I wouldn't chase it really aggressively because I think they can turn back the other way pretty quickly. Gold's probably the exception, but if you look at iron ore, for example, the fundamentals of the market haven't really changed all that much. The prices had a bit of a rally. The whole market was underweight or short, so you've seen Fortescue and Rio and those guys play a huge amount of catch up. I don't think it continues. I don't think the easy money or the quick money's been made.
Ben, you've got to walk to Ayers Rock to get a bull out there to find one.
Yeah.
Does that mean our market's going to grind higher in the face of a fairly pessimistic outlook?
Yeah, I think it probably can, because I think a lot of the larger fund managers still don't seem to believe the rally that we're seeing to date. They're holding lots of cash, and the old saying is bull markets are born out of pessimism, and it still feels to me like there is a lot of pessimism out there. So look, I think historically bear markets last about 18 months. We're probably about 14, 15 months into the current one. And I reckon, potentially the banks doing capital raisings could be the turning point for the market, given the index components that they've got of the ASX 200.
Okay, there you go. The market, it was a funny old year in 16, but it could be quite profitable in 2017 if you just get your stock picks right.